Hello everyone, I hope you are all doing very well in these fantastic times. Welcome to the FF Virtual Arena where we are hosting you today. I will be guiding you through this journey. I am the Editor-in-Chief at FF News, Ali Paterson, and today we're going to be taking a wee bit of a look at the best of breed analytics and technology to cope with market uncertainty, because I'm not sure if you've been watching the news a lot recently, but there's a lot of strange things happening out there that we want to try and have technology analytics in place to be able to understand it. Joining me today, we have got a fantastic panel. First of all, can I please welcome Gennadiy Friedman, the MD at Enfusion. Gennadiy, just tell us a little bit about yourself. Whereabouts in the world are you today?
Yeah, thank you, Ali. My name is Gennadiy Friedman. I joined Enfusion back in 2022 as a managing director and part of portfolio management systems. In fact, I came from Enfusion from one of a global macro hedge fund, one of the first Enfusion clients. So it's been quite a unique transition to me personally. I've been with part of hedge fund community for a big part of my professional career with a focus on risk valuation and helping generally build global front-to-back flows and control process for multi-billion-dollar hedge funds.
Excellent, and I'm very glad that we have you on board for this. Also joining the panel, we have Kahl, the president at FINCAD. Christian, well, whereabouts in the world are you, and tell us a little bit about yourself.
Hi, Ali. I'm very excited for you having me on your show today. I'm joining you from Germany. I'm a mathematician by education, I'm a quant by career, and now I'm the president of FINCAD with passion. Having spent many years on sell-side trading floors, leveraging my aptitude for numbers and analytics, I joined FINCAD about 6 years ago, leading many teams in this organization from client services to product strategy. After the acquisition of FINCAD by Zafin, I'm now leading the organization.
I want to let's start this, and Christian, I'm going straight back to you because I want to break that down a little bit.
Sure.
I've been very familiar with Zafin for many years, but FINCAD is something that I know very little about. So can you just tell myself, but also the audience, tell us a little bit about FINCAD?
Sure, absolutely. FINCAD has been around for over 30 years, and we empower capital markets participants to solve complex derivative and fixed income problems across all asset classes with innovative simplicity. Our unique curve model and scenario framework gives you a holistic view of the risk in a cross-asset portfolio. Our solution levels the playing field by offering the analytics horsepower with innovative simplicity, control, and transparency to all capital markets participants who want to make risk management their competitive advantage.
Excellent. Can we break that down a little bit further? I want to get something a little bit organic with you. Let's just to sort of follow up on that. What are some of the reactions from your clients been to this? Because the idea of leveling the playing field and enabling more niche houses to be able to access this, I like the appeal of that. What are some of your customers' reaction to this?
Yeah, I think the element of leveling the playing field is really where FINCAD originated, whereby sophisticated sell and buy side institutions definitely had a legs up when employing complex models and algorithms. What we are trying to achieve is to make the buyer's journey for capital markets to get access to sophisticated analytics as streamlined and efficient as possible. I think for us, what matters is that the client is up and running and gets a close understanding of the analytics in as simple steps as possible.
Excellent, very well said. Well, what can investors expect from the current state of financial markets with the rise in inflation that we're seeing across continents, but also with supply chain disruption? Christian.
Yeah, there's absolutely no doubt that inflation will dominate financial markets for some time to come. What we're seeing today is that the recent prints of inflation figures are significantly above the targets of central banks across the United Kingdom, Euro, and the US. We've seen inflation across these geographies peaking at 12, 10, and 8%. But what we also see in the market is that it's not only the inflation today that is top of the mind of investors. It's equally that investors anticipate high inflation figures to stay for some time to come. Looking into the inflation swap markets at the 1 and 3 year point, we see that at the 3 year time horizon in the UK and Euro, we still have inflation swap rates trading at 5 and 3% respectively. That's still 100 and 300 basis points respectively above the central bank's target. This has profound impacts on the rate setting of central banks. Central banks have raised interest rate from historically low rates of close to 0% to 3, 2, and 1% respectively across these geographies. We also see that the yield curve is anticipating further rising rates to come in very short order, with a very steep curve at the front end. What's somewhat worryingly is that the yield curve in the middle part is inverted, which is a strong indicator of recession. So what we're facing is inflation is significantly too high. Interest rates have been raised from historically low levels, and there's further rising rates to come. This not only impacts the markets for inflation and rates, but equally translates to assets being under pressure. We see a lot of uncertainty and volatility in the market, and clearly the rising rate environment will have a direct impact on exchange rates and exchange traded options.
Absolutely, Jenna. I can see you itching to step in here. Where from your side of things, where do you see the current state of financial markets, again with this rise in inflation, but also again supply chain disruption is something that's happening again in multiple places?
Yes, thank you, Ali. It's a great question. I would like to highlight several key points that have been shaping the global outlook and trading strategies for the market participants. So yes, indeed, inflation has been on the rise. It hit 40-year high recently, and it is putting a tremendous pressure on the company's earnings due to the higher cost of capital, indirectly impacting the stock performance. If you look back at September job report, we added over 260,000 jobs, which seems to be great news for the economy, but it also creates additional concerns about potential future rate increase. And again, there's always a fine dance for the Fed between keeping inflation under control without pushing the economy down toward the recession. So if we look at the market dynamics, the curve in fact has been inverted for quite some time. And when you compare the spread between 2 year and 30 years, it's touched over 30 basis points back in August. And historically, every recession since mid-50s generally followed by the inverted yield curve. And on the top of that, add the impact of COVID-19, which was further amplified by the war in Ukraine. Now, all this created a long-lasting damage to supply chain.
That's a good point. I just want to get your opinion there around obviously there's certain elements that are generally speaking outside of people's control, but then there's also some things that can be action. I'm talking about things such as the supply chain, where there's more ability to take action there. What sort of impact has the supply chain had on the current financial markets?
So what we've seen with supply chain disruption as a rebound of the COVID-19 crisis has certainly made the inflationary pressure worse. This combined with the war in Ukraine and the significant increase in energy prices is yet another driver of high inflations, where central banks are still trying to find the right measures in Europe to get this under control. From an investor point of view, rising rates is high on investors' mind. But what's equally important here is to understand that with the supply chain disruption, it's not so certain that the rise in rates will go hand in hand with inflation coming down. And here we're really identifying something that's critically important. That is that what assumed to be normal might no longer be normal. And here I'm talking about the assumption around correlation of assets, which is definitely under stress and under test in this environment.
Excellent. Now, Genna, I want to touch base with you here because there's a lot of uncertainty out there, and because of that, there goes hand in hand with that a little bit of opportunity. So, what opportunities are you seeing for market players, and what are some of the new strategies that they need to consider before investing?
So let me first address what it means for the hedge fund in general. So first of all, investors are looking for the solid risk-adjusted return on capital, which really translates into higher Sharpe ratio. Definitely more transparency in investment portfolio strategies, and you can see a lot of good due diligence going on these days. There is a more demand for operational precision and control. And finally, when it comes to solid risk management practice and valuation, and here it's not just about risk, real-time risk in P&L and time series analysis or various stress tests, but it also comes down to internal risk policies and procedures, including decoupling the trading and risk function within the organizations. So we're definitely entering into a new regime, and this regime is categorized by tighter financial conditions, less liquidity, high volatility, and general higher risk premium. And these and other factors not only create an array of different opportunities among the hedge funds and traditional asset managers, but also raise certain questions. And just look at a few examples. If you just look at the ESG investment stands for ecology, social, and governance. And the war in Ukraine created new concerns for ESG investors, with oil and natural gas companies delivering a tremendous yet-their return. And it's highlight again that the world dependency on extractable natural resources. However, we do believe that the process of sustainable and socially responsible investments is irreversible process with a longer time horizon. Another strategy I would like to mention is an increase in quantitative trading. With a high market volatility, high volume trading, this portfolio managers typically can relatively quickly rebalance the portfolio within less than 30 days. And then when you look on the other spectrum, you have a systemic macro hedge funds, whose approach goes far beyond just traditional long-short equity. Typically, these funds, they use various products to take a certain view on a particular country or the sector. One other strategy I would like to mention is a relative value trading. And here we talk about classic convertible arbitrage. What's interesting about this strategy is the converts market is relatively small comparing to other markets, but it's very intense from a data perspective. So companies are looking into data, and that's the key. It's a fundamental security, master data, and obviously the modeling from the modeling side. We see a lot of curve trading activities. When the market participants play the curve, goes butterfly, for example, execute butterfly strategies and similar. And there is quite a lot of activities in the volatility trading expressed in the variance volatility swaps for foreign trade bonds.
That's I like what you're saying right there around some of the opportunities that could be done. Christian, can I get you to weigh in here? What are some of the new strategies that need to be considered before investing at the moment?
Yeah, absolutely. And I think what's very important to keep in mind when talking about opportunities investing is that we're looking to spot trends, pattern, and anomalies in the market. So what investors are looking for, what are assets that are potentially mispriced? Genna rightly pointed out that the convertible bond market is very actively looked at, in particular under the context of distressed debt. It provides a great opportunity for investors and hedge funds alike. What equally comes to mind, and I think we see a great interest across our prospect and client bases to look at volatility instruments. The uncertainty really brought to fruition that people are looking to both diversify their portfolios, but equally to take a very directional view. So variance swaps, volatility swaps, VIX futures and options, as well as structured volatility products are definitely something where we see an influx of activity. Equally too, and this sort of is a somewhat trend even triggered by regulatory transition. We shouldn't forget that the LIBOR transition is still ongoing, underway, and above all of this uncertainty is that the industry hasn't fully figured out to standardize the market for interest rate volatility instruments, both for caps as well as for swaptions. So we see a heightened interest in trading rates instruments across the short end of the curve, in particular these days around meeting dates and turn pressure. The jumps around announcement of central banks meetings is very important to consider here. But equally too, with inverted yield curves, we see a strong interest in CMS products, CMS spread options, as well as callable CMS products. And last, and this is really to look into the anomalies in the market. When we look at diversifying portfolios, we're talking typically around correlation assumptions. And what we see with the rising inflation environment is that some traditional patterns around correlation have simply broken down. And I give you two examples. One is for stock bond correlation, which typically moved in tandem at low inflation regimes. But what we see now is that the increase in inflation triggered for yields to increase and for stocks to fall, which is a break over the historical pattern we've seen in recent years. The other example is with regards to equity volatility assumptions. We've seen equity markets fall as much as 40% from their peak level, all the while equity volatility has stayed rather benign. And this brought to light a very interesting trade in the market, which is a volatility knockout option, which probably has been the most successful trade in 2021.
Thank you all so much for taking the time to speak with us today. First of all, Christian, where best to find out more about yourself and FINCAD?
I think the best place to go is to our website at www.fincad.com. I would encourage any viewer of this webinar to reach out to me on LinkedIn, and I'm very happy to engage with all of you personally and or direct you to a very trusted resource in my organization.
Excellent. And Gennadiy, where best to find out more about yourself and Enfusion? Where best to reach out?
Yes, totally. I totally support what Christian said. I think between the website, our website, company's website, and LinkedIn, you'll find probably most of the information. Any questions you have, please feel free to reach out to us.
I've been your host, Ali Paterson. Thank you all very much.
Thank you very much, Ali.
Thank you.